Welcome, everybody. My name is Chris McDonald at SMS, and I'm excited to bring to you today two guests that will talk about the index standard. And over the next 20 or 30 minutes or so, we'll really dive into the index landscape, what we're seeing, trends, and where we're going to go from here. So with that, I'd like to introduce two gentlemen. One is Laurence Black. Laurence is the founder of the Index Standard and an index advisor to Robert J. Shiller. Before founding the Index Standard, Laurence was a head of quantitative indices at Barclays. Prior to Barclays, he worked at Lehman Brothers, Deutsche Bank, and Credit Suisse in a variety of roles. He has appeared in podcasts and interviews with the Financial Times, Think Advisor, and Bloomberg, and is a frequent contributor on index thought leadership pieces. Welcome, Laurence.
Thanks, Chris. Great to be here.
And next, I'd like to introduce Branislav Nikolic, Managing Director and Head of Insurance at the Index Standard. Branislav is an established thought leader specializing in annuities and retirement income planning. He joined the Index Standard after a decade at Canex Financial Exchanges, where as Vice President of Research, he was instrumental in extending Canex's strong presence in the retirement income space. Branislav holds a master's degree in probability and financial engineering and a PhD in applied mathematics from York University in Toronto, where he is also a lecturer in finance and mathematics. Branislav holds the designation of Financial Risk Manager. He is a Research Fellow Alliance for Lifetime Income and is currently serving on the board of National Association for Fixed Annuities, or NAFA, and is a prolific author for business and trade publications and a frequent speaker at insurance seminars. Welcome, Branislav.
Thank you, Chris. Pleasure to be here.
Well, great having you guys, and really looking forward to the discussion here over the next 20 minutes or so. I guess, Laurence, I'll start with you, and really, why don't you talk about what the Index Standard is?
Sure. So you can think about the Index Standard as a little bit Morningstar-like. Like Morningstar, we rate and evaluate indices, except we focus on the insurance and the structured product space. Now, there's a couple other things that we do. Secondly, we actually produce forecasts. We really want to help our clients think about the future. And then the third thing that we do is we actually provide model allocations for FIAs and IULs. They're incredibly difficult to allocate to. They've become very complex products. So we provide simple guides for our clients to help them understand them and then how to allocate to them. And we've also involved in a variety of research projects with a number of high-profile clients.
Wonderful, yeah, and over the years we've certainly seen the Index Standard become a mainstay at events and with advisors to really analyze what's going on in the index landscape. So speaking of that, it's ever changing, this index landscape, and we've seen a lot of changes over the last few years. Can you speak to the changes in that index landscape and what we've seen, and maybe what we're looking at in the future?
Sure. So maybe let's start off, and then I'll hand over to Branislav. So, I think we've seen a tremendous number of indices. We kind of see it today, over 150 being used, and it's probably about 250 that have been utilized over the last 15 years. And I'd say there are a couple clear trends. Firstly, we see sort of complexity and innovation increasing. Now, why is this? Well, I think that every carrier wants to have something new and unique and innovative and, something shiny to sell. So they're all trying to find something that's interesting, something with a story, and that's what they want to put into their product and then say, we've got the latest and greatest. So that drives demand. And then the second thing is, we're all aware of the improvements in technology. We've got AI, and data systems have really improved, and that's allowing these index developers to come up with much more interesting and more creative ways to sort of develop and design in indices. So those are two key points from my point of view, but I know Branislav's got some other things to say as well.
Thank you, Laurence. So for me, the key insight comes from the space that I've spent last decade or so in, which is annuities, and how is this trend of innovation from institutional knowledge being fed into the annuities that back in the day were simple products. You would have one or two, possibly three benchmark indices, few different strategies, and the story was really more in line with the typical annuity story. Income for life, and then some accumulation along the way if you never end up using the lifetime income provisions. Now that changed, and I think some of this innovation led to it. The other one is response to the market environment. We've seen market volatility. There was a response to that. We saw low interest rates. We saw response to that in index design and annuity strategy design. So I think the annuity products and index life insurance, for that matter, really try to keep pace with both innovation that Laurence is mentioning and the developments in the market, both on interest rates and the equity side.
Very insightful. So you hear a lot about backcasting, and now we're starting to hear a lot about forecasting. So maybe I'll look back to you, Laurence. Why should people think about forecasting relative or versus backcasting?
Yeah. So, let me take a pause. I mean, when I founded the Index Standard, one of the sort of guiding principles was I wanted to help my grandmother. We wanted to think about it. If this was my grandmother, I really want her to help understand these products. Now, why you want to think about forecasting is the following. All of us drive cars, and we all look through the front windshield, and then we look through the rearview mirror. But we do both of it. And we don't just drive our cars by looking in the rearview mirror. So now if you just look at allocations that show you the past illustrations, you're effectively driving your car by looking in that rearview mirror. And that's not really optimal. Let me give you like a real life example, and this is just applying common logic from an illustration. So right now, if we take any technology index, the last 10 years, that's showing you about 16 or 17% performance. Now, pick any large technology index, you'll probably find Apple's one of the bigger constituents of that. It's one of the Mag 7. So let's take Apple's market cap and apply that 16% historical illustration and see what happens if we roll that forward. So Apple's market cap today is about 3.2 trillion. And if I compound 16% on 3.2 trillion, I get that Apple's market cap has to be over 14 trillion in the next 10 years, if you believe that illustration. Now, let me put that into context. The US total GDP is about 27 trillion. So that means for that to be true, probably all have to be living in Apple houses, driving Apple cars, having Apple TVs, right? Does that make sense? Not really, right? The German GDP is just about 4 trillion. So what we think is, it does make sense to look back, but you also want to look forward as to get a sense of what's coming. And then, my final point is there's a very famous economist called Daniel Kahneman, and he was a behavioral economist. And he all says we've all got recency bias. So we kind of tend to remember what's just happened in the last couple of years. And we've had great returns from the S&P. So we all remember that, but you really want to be diversified. So forecasting allows us to look forward and think about diversification. Great
analogy there. I do have many Apple TVs, but no Apple car yet. So we got a ways to go. Yeah. So let's talk a little bit about the risk control indices that we've seen become very, very popular, and maybe talk a little bit about where they are currently in the landscape. And so we've seen some positives, we've seen some negatives. And in terms of the narrative of risk control indices, maybe speak to those narratives and what you really see in terms of performance and why maybe they're so hard to explain and then maybe where they're going.
Cool. That's an awesome question, and there's a lot embedded in there. So I think Branislav and I will probably kind of split that one. But let me kick off. So what I would say is, let's talk about 2024 performance, which is kind of similar to 2023, and I'll talk a little bit at year to date, and then what's been happening, and Branislav will throw in some comments. So in 2024, we saw the S&P had a really, it was a home run year. It was over 23%. Now, if I look at EFA, just as a kind of bit of context, that's European, Asian, and Eastern stocks, that was about 1.7%. So, pretty low. And then now equity only risk control indices, they actually had a solid 2024. They actually returned over 10%. So pretty good when you're getting par rates of 100, 150. And then if I look at, let's say, the multi-asset indices that's got equities, bonds, or even commodities. Now those ones struggled. They, on average were really around 1 and 1.5%. So it wasn't a great outcome. So let me make two observations. Firstly, if I look at 2025, things have totally flipped. So the S&P's down. We know it's about down 4% as we speak, and it's the middle of March. But if I kind of look where MSCI EFA is, that's had a solid year. That's up over 7%. And some of these multi-asset indices have actually done pretty well. They're up between 1 and 2%. And you think about the credit you're getting on that, you're probably up, you're getting 200-300% par rate on a multi-asset index. So you're probably up 4 or 5%. So it's really been a turnaround. Now, what happened in 2023 and 2022? So what happened was, and from this, I think a lot of people were disillusioned with multi-asset risk control indices. And I'm choosing my words carefully because I want to say multi-asset, and then I want to talk about risk control. Now, what happened with multi-asset indices and multi-asset risk control was that when these guys were designing these indices, all these banks, asset managers, and index providers, they rely on a key concept called sort of diversification and decorrelation. Now, that's just a fancy way of saying that markets are yin and yang. Bonds usually go up and equities go down. They offset each other. Except what happened in 2022 and 2023, bonds went down and equities went down. So that caused the multi-asset indices to go down. So that's why we've seen a disillusionment. And it's kind of unfortunate that people are disillusioned. And then almost in 2025 was when you actually want those in your sort of allocation portfolio because their performance has been pretty solid. So last remark before I hand over to Branislav is, we at the Index Standard have gone and looked at the risk control feature and whether you apply that risk control feature to the S&P or the NASDAQ as a risk control feature by itself, or if you apply it on a multi-asset index. Now that risk control feature is actually very robust. In some of our research going back over 100 years, what we see is actually done very well. It has better risk-adjusted returns than your benchmark index. But people have kind of bringing in this multi-asset poor performance and attributing it all to risk control. I would separate them. Multi-asset has struggled, but the risk control function has actually done very well. Branislav, your thoughts?
Yeah, I would like to piggyback on what Laurence just said and put it in a context, again, in the product that we mostly care about, which is indexed annuities or indexed life insurance. And if you go back, multi-asset indices, the intentions were good. We always thought about don't put all your eggs into one basket. Everyone is pitching 60-40 portfolio is the way to go. This was in line with that story. When someone is talking about returns of multi-asset indices in 2022 and 2023, I always suggest go look back into your 60-40 and tell me what happened. Did that fare any better? Because this was just a codified way to do the thing that we all agreed was the right thing to do, diversify between stocks and bonds. Then you had people thinking even further and adding different components like commodities or gold. And why is that? Again, in the context of annuity, what's your goal? Your goal is to accumulate in a principal protected way certain amount of wealth. Now, fixed index annuity in the past was simple proposition, 4 to 7% return based on some simple strategies on few benchmark indices. This was just kind of adding into that, but allowing you to get a credit, hopefully, when equity indices strike out, that you will get your singles and doubles through some of these multi-asset indices. So I think intentions were good. It's just there was tough period to go through when everything dropped like the rock. So that's one observation. The other observation and chief complaint when you think about annuities is how annuity rates are set. What are you getting in terms of your caps and pars, and how do your credits are getting calculated? I think some of these indices that Laurence mentioned, be they multi-asset or risk control, had really few goals behind them. One is to provide stability in renewal parameters of the annuity. So with risk control, you would eliminate the volatility almost completely from that equation, and then the participation rates, if the carrier budgets are stable, would not change for the duration of the product. That was a response to the actual need from the market. Those are some things that I think people forget on why we went on this road of innovation. Now, I wouldn't necessarily say that I'm in the camp that we need 150 options. I think maybe 3 dozen would work equally fine. But that's where the innovation went, and how it applies to our products that are linked to it.
Very interesting. We're getting a ton of questions, obviously, on this topic. And just as a reminder to everybody, if you do have a question, there's a Q&A box that you can type into, and we'll get to most of those. If not, we certainly will follow up after the call. And then also a reminder, there will be a survey at the end. We have a few more questions with these gentlemen, but survey at the end as well for you to fill out. So one last question on the risk control indices. Where do you think it's going to go? I mean, how do you guys get this narrative out there to really help advisors understand kind of the separation between the two that you mentioned?
Yeah. So what we're seeing, I think, with some of this disillusionment with the multi-asset indices, what the index providers have really focused on over the last couple of years is something that makes sense. So what they've done is they've evolved the risk control mechanism, and they're using something called intraday risk control. Now, what does that mean? Your typical risk control index from a couple of years ago, a decade ago, what it would do is it would look at volatility, and it would use that as a signal to determine how much to put into, let's say, the S&P, or how much to put into cash. Now, these indices toggle between cash and a risky asset like the S&P or Russell or NASDAQ. Now, they were looking at 40-day volatility for the preceding 40 days. Now, what they're doing now with this new technique called intraday volatility control, they're looking, as the kind of name implies, during the trading days. And they may be taking 7 observations. And the way I think about that, that's almost like having power brakes on your car. It's very reactive. So I think they've improved the risk control mechanism. And also what they're doing is they're just applying it typically to very simple benchmark indices. We've seen NASDAQ do this. We've seen the S&P. We've probably seen Russell. There's a company called Salt Financial who are developing a lot of these intradays. And now, if you compare an intraday risk control index, let's say on a benchmark index, it actually has some value because it kind of allows you very stable pricing parameters, and actually it outperforms. Now, what we've seen is we don't like backtesting at the index standard. Now, for those of your listeners, you may remember there was a bit of a bump in the markets in 24 from over the summertime. We went and had a look at that bump when markets went down from July to September. We analyzed 4 risk control indices that use the intraday technique, and we said, how do they compare to your standard risk control index and the underlying benchmark? And what we found is those intraday risk control indices did actually have better breaks. They were more reactive. They had lower drawdowns. They did what they're supposed to do. And then, last sort of thought for me is, I like this sort of focus on simplicity. You're really just taking a risk control feature and you're putting it with a benchmark index. So if the benchmark index goes down, my risk control index will go down. It's much easier to explain for the advisor. So I think that kind of fits in with providing something efficient but easy to explain.
Yeah, that makes a ton of sense. Simplicity, but still with the value that the risk control brings to the table. Branislav, I'll go to you on this one. And Laurence hit on it a little bit earlier, but why are we seeing so many different new crediting strategies?
So again, historically, and going back to the roots of what an FIA is, it's a fixed annuity. And the basis for comparison ought to be fixed annuity or multi-year guaranteed annuity, which is basically fixed credit for a given period of time. Now, with FIAs, I think that the idea was to allow those who are still conservative, but would like to take some variability in that outcome to say, I'll get returns that are obviously principal protected or credits. And then if the fixed rate is 5, I will be okay with a range anywhere from 3 to 7 or 4 to 7. Now, you were able to do that. Now, we went into a period of increased volatility. We went into a period of low interest rates. And I think what some realized that some of these strategies that were offered, they were looked basically between 2 fixed points on index performance. Maybe not. That's not good for different market environments, and they're not kind of one-to-one with the convictions or expectations. So I think the strategies evolved in a sense to map out the stories or the narratives. Are you expecting whatever index that you're allocating to go up steadily over next year, 2 years, 3 years? There is one strategy for you. Are you expecting this to be very volatile? So maybe you want to lock your gains more often. Maybe you want to do use that ratchet effect every year. So that gave you basically that temporal, quote unquote, diversification on multi-year strategies or single-year strategies. Then we have strategies that are more conservative in nature. And again, this comes the story between how you apply this in FIAs versus IULs. FIAs, zero is your hero. In IULs, you still need that account value to go up because you have the actual cost being drained. So then you have the triggers, the dual triggers, the higher floor strategies, which would kind of, with a minimal effort, guarantee some low returns. And then if the thresholds are breached, add to it. You will get strategies. Again, I personally disagree with this, but you have like inverse trigger strategies. Oh, if index doesn't do well, you'll get some exposure or some credit. Now, this is like short selling, but I don't think we should be trading throughout annuities. But that's basically allowing people to align their market conviction and allowing the advisors to align their sales stories with what they expect that will happen now that you have this more constrained version of crediting through an annuity.
Great. A lot in there. Anything else on the IUL side? I mean, I really did want to give you guys the opportunity to talk about the other products, but anything more on we've talked a lot about the FIA, but anything more on the IUL side?
For me, I think that the key is, again, speaking about indexed accounts, understanding the key difference that I already mentioned, that IULs come with different costs and they are the lifetime game as opposed to something that you may change in the next 5, 7, 10 years. They have their own primary purpose. And there, I think it's even more important to talk about steady credits for that account to constantly go up. So I would say that the allocations there, there's an even higher imperative for them to be diversified, to look into decorrelated indices, to look into combination of those with the conservative strategies, with higher floors, with credits that are based on a minimal increases in the market, sometimes fixed rates or fixed accounts, and bring that into the picture more holistically, because you don't have a chance to change your IUL as often if something does not look that great. But it also then allows you to look into the selection of the product and see what are the options, what are the strategies, what are the indices, what is the reputation of a carrier for keeping the renewal rates stable. Again, we see that stability more in the IUL space than the FIA space, but those are some things that come into consideration where I would draw the difference between the two.
Thanks. Appreciate it. 2 more, and we'll get you guys out of here. Laurence, what do the latest forecasts, what are they telling us?
Sure. So at the Index Standard, we've been collecting forecasts for the last 4 or 5 years that we've been doing business. But actually, this is something that's been done for over 100 years. And it really began with Charles Dow and all the way to Jack Bogle. People were trying to forecast. And what we do today is we go and pick up about 35, we go to 35 asset managers and we pick up their 10-year forecasts. And what we're seeing is really a couple things. One, it makes sense to be diversified because actually there are forecasts for international markets are higher than the US. So on a total return basis, the S&P, they're expecting about 6.6. But if I look at IFA, they're expecting about 7.8, and emerging markets, 8.2. So much higher in international markets. And I know that everyone on the call, we all love the S&P, but I think, we've seen year to date that it can struggle, and that's been a bit of a surprise. So it does make sense to be diversified. And, you want to think about the other asset classes. If I look at US Ag, that's the kind of benchmark for bonds, their expected returns are about 4% there. And then interestingly, commodities have struggled over the last couple of years. So commodity returns are expected to be about 6.1. And then lastly, I want to touch on gold because that's sometimes used as a hedge. Now, what we've seen is gold has done tremendously well over the last couple of years. In fact, it's kind of $3,000 at almost an all-time high. The expected return over the next 10 years for gold is just 1.5. So what people are expecting is that gold's done very well and may come back down to the sort of average and may have some slightly lower returns. And then final observation is, what I did mention, all the numbers I mentioned were total return numbers. So they include dividends. So if I look at the S&P, and it's often used as a price return in an insurance wrapper, the price return expectations for the S&P are about 4.8, so a little bit lower with dividends. So that's the expected return, average return over the next 10 years. So, my take is it really makes sense to be diversified, consider international, and blend in, maybe some commodities as well.
Well, thank you guys for the time today. I really appreciate it. I do have one more question for you before we hopefully I didn't bring down the brain power too much here, but really appreciate your insights as always. So we're going to have the opportunity for those that are attending to fill out the survey at the end and request and raise your hand for to get in touch with the Index Standard. But in the meantime, what can they do, anybody on this call, to learn more about the Index Standard?
Sure. Branislav, why don't you take that one?
Yeah, so what they can do immediately is go on our website, register for a free account, and get a sample of what we have an offer. We do have a report on indices, on index performance that we publish twice a year, once at the beginning of the year, once in the middle of the year. We have another report that conveys the story of what we call Wisdom of Wall Street that Laurence just mentioned. We publish that. We send that in a newsletter. And then our services really span, as Laurence mentioned, everything from index rating, forecasts, annuity, credit forecasting, and model allocation. So through a plan, either as an individual or through your marketing organization, you can get access to these services and really start using these to educate your clients and to set the proper expectations when used in conjunction with the rest of carrier collateral and the sales stories that I believe people on the ground are the best at telling. This just gives them one more talking point and gives them a bookend of the expectations for the future.
Yeah. And Chris, could I just maybe throw in one other comment that I just wanted to make is that, everything at the Index Standard we do is really independent. In terms of the ownership, the employees own most of the company, and some of our shareholders, are my former colleagues. So we have no one from the insurance industry as a shareholder, and everything we do is independence, it's algorithmic. We try to be unbiased, we follow the data, and we really want people to do better. We want to try and help them understand the product they're buying and put more money into their pockets.
Well, Laurence, Branislav, thank you so much for joining us, and appreciate your insights as always, and the work that you guys do. It's very valuable for us, and is is the new way to analyze indices moving forward. So appreciate it, and thanks for joining us. And thank you all for joining us as well. We will certainly be in touch, and hang on for that survey. Have a great day.